Welcome. This is Jelena Ogilvie with Principal Wealth Partners, and I'm thrilled to kick off this new year with a conversation with Matt Coe, who is an investment specialist with T. Rowe Price and a chartered financial analyst. He is a member of one of the most respected multi-asset strategy teams in the industry. This team consists of 12 portfolio managers, over 60 research analysts, and manages over $300 billion. On this team, Matt is a proxy portfolio manager for their target allocation strategies and is responsible for the communication of the firm's views on not only asset allocation, but the global capital markets. Today, Matt will discuss the outlook for 2021, how to think about opportunities in this environment, and answer the question that the media loves to raise. Is a 60-40 portfolio still viable? Enjoy this timely 35-minute discussion. Thank you. Well, Happy New Year, everyone. I'm sure you're just as excited to have 2020, the year of the pandemic, behind us. Welcome to 2021, the year, I guess, of the vaccine. I'm Jelena Ogilvie with Principal Wealth Partners. I'm delighted to be here today with Matt Coe, an investment specialist from T. Rowe Price. Matt, thanks again for joining us. I know you have been kind enough to, been at our past events, and good to see you.
Good to see you. Excited to be here.
So I asked your team for a factoid, and since a lot of us were indoors for the pandemic, I understand that you have never seen the Star Wars episodes and that you went through all of them with your children through Disney Plus during the pandemic.
That's correct. Yes. No, growing up, I was one of those children who didn't really believe in sort of fairy tales and make believe. And so sci-fi certainly falls into that. So for me, Star Wars was one of those things I just couldn't relate to. But now that I have two younger children, they wanted, or I guess they heard through their friends about Star Wars, and so they wanted to watch it. And so I took the opportunity to watch through the entire series from start to finish. So it's been a lot of fun.
Well, good for you. I did the same thing, and we enjoyed it as well. So I also want to thank you because you spent some time with me before this event, sharing your views. And so based on that, we put some questions together for you. So are you ready to discuss 2021?
Let's do it. Yeah.
All right, great. So I'm going to share my screen, and I am going to start. Can you see my screen?
I can, yes.
Okay. So we are going to start with, of course, what we experienced in 2020 with the pandemic. And unfortunately, as we know, it derailed the economy, employment, even the way we structure our family on a day-to-day basis. We're still dealing with unthinkable numbers, as you can see on the slide in the blue, that continue to spike. However, we know that the vaccines are on the horizon. So I'm curious to see your views for 2021 and maybe a longer-term outlook based on that.
Yeah, absolutely. So I think for myself and a number of other investment associates on the multi-asset team within T. Rowe Price, multi-asset being those who tend to use sort of stocks, bonds globally to construct mixed asset portfolios. Our views are that 2021 is the year of one of recovery, of post-pandemic healing, and what individuals need to do is focus on the destination. The destination being, Christmas 2021 is going to be one where you will more readily gather with friends and family. Summer 2021 is potentially a series of months where all of us as a nation will get on a flight and go someplace near the coast and actually enjoy the summer versus hunkering down in the house and maybe just playing in the backyard. So focus on the destination. The destination is that COVID trends that are clearly today going the wrong way will no longer have as much of an impact on the economy, on individual behavior from a day-to-day perspective. So if you focus on that destination, that means, and if you use some imagination, think about all the things you weren't able to do this year in or you weren't able to do in 2020, but you'll be able to do in 2021. And as a result, those are some of the investment-related implications. Now, the path to get to that destination is treacherous, right? Make no mistake. Year-end 2020, early part of 2021, you're going to have continual sort of case surges with COVID related, and then as a result, sort of impacts to mortality. and that will result in businesses shuttering, economies rolling back. Now, we have a bridge to get to that destination in the form of additional government stimulus and other tools that politicians are using to try and help defray some of the economic impacts. So for us, that means in the short term, right, there can be bouts of volatility, there can be some pockets of concerns. But if we look past just the short term into the longer term, what we'll likely see is an emerging reacceleration of not just the U.S. economy, but the global economy. And that tends to bode very, very well for the investment markets as a whole and for sort of everything that you can invest in. So for us, that means, again, prepare for what that recovery looks like, right? Keep your eyes on that destination and what that means in terms of investment implications.
That's great. And you mentioned stimulus, which we've talked a lot about in the past year. And I've used the word unprecedented a lot lately, but we've seen an unprecedented amount of stimulus. Has it worked? Has the stimulus helped in this recovery? And what's your view going forward on further stimulus?
Yeah, so we've enacted globally government spending as well as central bank interventions to help shore up the economies, local economies, as well as the financial markets. Over $25 trillion of global stimulus. Now, let me put that into perspective. If you think about what happened after 2009, when there was the great financial crisis and all the banks had to be ring-fenced in terms of trying to bail out banks and keep the capital markets functioning, think about all the dollars committed in that 2009 timeframe, multiply it by 2, if not 3, and that is essentially what we have today. So said differently, this truly is unprecedented. Last time, a decade ago, we said it was unprecedented. This is truly unprecedented. It's multiple fold of stimulus and intervention. And what that has allowed the markets to do is in that period in March and April where we had sort of lack of liquidity, lack of banks and other financial intermediaries wanting to transact, we're seeing excess liquidity today. Excess liquidity translating into perhaps speculative risk-taking to a certain degree. What we're seeing is because there's been so much intervention and bond yields are so low, the opportunity cost for investors is essentially nothing. That's why we're seeing some of the speculative behavior in areas like Bitcoin and other cryptocurrencies. If you haven't been paying attention, they've started to do well again. Bitcoin was left for dead a couple of years ago. Now it's gone from less than 10,000 to over 20,000 and continually hits new highs each and every day. That sort of speculative behavior only occurs when individuals say, I have nothing else to lose. I can't make money getting any interest or any income off of safe. I might as well just sort of roll the dice and put it into something more speculative. And that's why you have areas like cryptocurrencies doing well. And as well, the entire equity markets has traded considerably higher from the March lows. The stock market is up over 50% from the March lows. So perhaps there is some worries that the excessive or the stimulus has led to perhaps some pockets of excessive optimism in the investor market.
So based on that comment, is your view that we're going to see further stimulus? And if we don't, could that be an effect on the market?
So we expect further levels of stimulus. I think what we're seeing is that when we have pockets of weakness here in the U.S. in terms of economic data, politicians are quickly coalescing around the idea of additional sort of bailouts for local governments and businesses to ensure that a firmer recovery takes place. As well, you have the central bank who has also opined that they are ready to step in with additional measures should the markets need so. So we do believe that additional forms of stimulus will occur over the course of 2021, should it be needed. Now, that being said, let's keep in the context the stimulus that we had in March and April of 2020. In that time period, it was pretty much every day a new stimulative bill was being passed here as well as across the globe. And the general tone was there are no bad actors. This is a global healthcare scare. It's a pandemic, right? No one was excessively leveraged. No one was taking sort of greedy bets on housing or condo flipping. This was something no one could prepare for. And so as a result, we had quick levels and massive amounts of stimulus to bail out the markets. In 2021, that story will start to shift. we will now have a little bit of finger pointing. Who got too much money? Who deserves to be bailed out? Who doesn't deserve to be bailed out? And as a result, while stimulus should still be forthcoming, it'll just be lesser forms of stimulus. And what that ultimately does is it puts the investment market perhaps on a little bit more fragile footing. I like to joke the trading wheels come off in 2021. The markets, investors are going to have to balance themselves based off of fundamentals. If the economic recovery is to the degree that a lot of investors expect, and that we do have this sort of post-pandemic recovery and surge in consumer spending, then yes, right, markets are off to newer highs. However, if we do have perhaps a pullback in spending, a continued sort of sluggishness in economic recovery, there could again be sort of pockets of volatility throughout 2021.
And with all of this stimulus, the media talks a lot about the concern about debt. And how do you think about that? It clearly becomes something longer term, but is it something we have to worry about in 2021, or how does that play out?
Yeah, so that brings up a great question. So far, the concerns around sort of excessive debt issuance by the federal government hasn't led to any real concerns. The price to pay for excessive debt issuance is essentially nothing. You go to a 10-year Treasury bond, it's around 1% or a little bit less than 1%. So perhaps some of the investment market, or maybe even politicians, has been sort of lulled into believing that you can just continually print money to the sky and there's no real price to pay. We tend to not agree. We do believe that ultimately all of this excessive debt issuance will lead to perhaps some inflationary pressures. For us, if we are looking at a recovery in not just 2021, but also 2022 and 2023, right? You have lower rates of unemployment. You have more of a participation from the broader populace in terms of their ability to spend and transact and travel. This should, in addition to the excessive debt issuance by the U.S. Government, lead to an upward pressure in inflation. And so that could have some repercussions at some point in the future. Now, it's too early to worry about that just yet, because we're still dealing with sort of the post-pandemic sort of initial recovery. So inflation pressures won't necessarily really be a heightened concern in the beginning of 2021, but sort of as the year progresses and depending upon how the data shakes out, that could be something that becomes a little bit more front and center with investors' minds. If not by the end of 2021, certainly by 2022, when we should be in a more full-throated recovery.
Okay, great. Thank you for that. I'm going to switch gears for a second here and talk about the valuations. And so despite the pandemic, the roller coaster of a ride that we saw in the market in the spring, the markets are back at all-time highs. We're recording this when the S&P is up around 15. On the flip side, even traditional bonds are up 7%. Can you talk a little bit about how you look at valuations at this point? Are there areas that are more attractive than others, and how do you implement that?
Yeah, so I think when thinking about valuations, most individuals sort of think through, is it risk on or risk off? Do I want to own stocks or do I not want to own stocks? And I would say that now is not the best time to make sort of hero-sized bets. What we're seeing is those areas of the markets that have done immensely well in this 2020 environment are trading at more historically elevated or expensive valuations. But that doesn't necessarily mean that it has to, as a result, go down in the coming year. Areas like U.S. Versus the rest of the world has done very, very well in terms of investment performance. However, the starting valuations is something you should consider. When looking at not just sort of, do I want to own stocks or bonds? Our answer is you still want to be invested. If you are looking for pockets of, sort of cheapness or relative valuation, it's not necessarily at the stocks versus bonds level. It's actually underneath the hood at what can you own within stocks. If you look at U.S. stocks, they're very, very expensive to the rest of the world. We've had a decade-long surge in U.S. equity prices and sort of the rest of the world languishing. And in this post-pandemic recovery, what we'll likely have is a coordinated global reacceleration. COVID-19 was not a U.S.-centric story. It impacted Asia. It impacted Europe. It impacted parts of Africa. And so all those regions, as they start to heal from the pandemic, you'll start to see improving business activity, improving consumer trends. And as a result, we believe the greater benefits could be had in owning more globally oriented investments than US-centric ones. As well, related to that, you could also look at what hasn't done quite as well here in the US. Growth stocks did very, very well, as in the 2020 pandemic environment. The work from home stocks tended to do very well. But in 2021, what we should see is a broadening market rally as individuals, again, go back to transacting, going back to sort of their normal behavior. You can see bombed out travel stocks doing well in 2021. You can also see industrials and home building stocks and other sort of more cyclically oriented parts of the investment market, like even financials or banks, doing better in 2021. So we believe that a broadening market rally should lift a number of boats, and perhaps better returns can be had in highlighting those areas of the markets that just haven't done as well in 2020 and have perhaps more room for appreciation over 2021.
Okay, great. And I'm going to shift here now over to the more traditional discussion of stocks versus bonds. When it comes to asset allocation, this is obviously the largest decision you make in your portfolio. And what we're showing here is the yields on both the broad bond market, which is the dark blue, and the stock market, which is the light blue. And they both are at unprecedented times. And what's interesting to me, and would love to get your thoughts on this, is that the bond market is yielding so much lower. I think it's probably a historical gap between the two. So when you decide in your team every day, how do you invest? Is it stocks or bonds? How do you make these decisions?
Yeah, so we certainly look at valuations for the two asset classes. Do we want to, have more offense in our portfolios and owning stocks? Do we want to be a little more defensive in terms of owning bonds? I think when you look at the stocks bonds consideration, for those who pay attention to things like PE multiple, price to earnings, essentially, what price are you paying per unit of, profitability from America's companies? It's very elevated relative to historic measures, but relative to what, right? It's not just in isolation, are stocks expensive or are they cheap, but relative to what else can I be investing in? So while PE multiples on stocks, perhaps show similarities to the late 90s when, people started talking about it being a bubble, or maybe in similarities to, sort of prior periods when you had sort of more elevated valuations, you have to keep in mind in the 90s, government bonds paid 5-6%. Today, government bonds pay 0.5% to about 1% across the entire curve. So relative to very, 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 very expensive bonds or very, very low yielding bonds, stocks look pretty attractive. You can also consider, what are you going to do if you're looking to, sort of invest your income? Do you want, or invest your money? Do you want to lock your money up at less than 1% for the next 10 years? Or do you actually want to generate a better income stream in owning equities themselves that pay almost nearly double in terms of income in the form of dividend yield, and also have the potential for additional capital appreciation or gains to be had in a recovery type of scenario? So for us, stocks versus bonds, we like stocks. We just don't believe that right now is the time to make a big hero-sized bet in terms of how much equity risk you want to have in your portfolio. Absolutely have it, stay invested, look to potentially add more to equities, should there be any pockets of volatility in the early part of 2021 due to COVID-related concerns.
Okay, great. And you just mentioned that you like stocks. We've experienced an interesting phenomena here where I feel like the pandemic created stocks that we loved and stocks that we hated. And a lot of the ones that we loved fell in what we call the growth category. And so I mentioned earlier, the S&P was up 15%. The growth index up right now is double that. And it has been for quite some time. So, the question that a lot of people are asking is this going to continue? Or are we going to start seeing some love for the value companies?
I believe that in the short term, we can see a rotation into the value-oriented companies. I think my earlier comment was that in the post-pandemic 2021, we should see a broadening market recovery. A broadening market recovery will allow for some more of the cyclically oriented businesses. Think about, again, banks, financials, industrials, materials companies, energy companies, oil and gas companies, as well as some of those travel and leisure sectors that haven't done very well over the course of 2020. They should all start to do well in that recovery in 2021. So a rotation from the growth to the value can certainly occur over the coming year. But make no mistake, this chart that you're seeing here in terms of growth outperformance versus value over the last decade plus, that is a secular story. The way that individuals transact, the way that businesses transact is much more technology oriented or technology enabled today than ever before. An interesting fact is that since in 2008, 2009, total e-commerce sales, online retail sales, made up less than 10% of total American retail sales. So all the dollars spent in transacting by consumers, less than 10% was done in an online digital format in 2008, 2009. By 2019, that number increased to about 15, 16%. So if you think about that, it took about a decade just to get another 5, 6% more in terms of digital e-commerce sales relative to all the dollars spent by the US consumers. From the beginning of 2020 to the end of March, during that pandemic period, total e-commerce sales made up over 25% of all the retail sales in the United States. And that level has stayed consistent since the pandemic concerns by the end of 2020. So what you see is, in less than about 3 months, about a decade's worth of gains was made in e-commerce digital sales penetration relative to total retail sales. Why is that? Well, it was out of necessity. I think a number of individuals are just worried about, venturing out to big box retail stores, or they weren't, allowed to do so. But in that experience, individuals are now starting to, start to question, why did I go to a store? It's a lot more convenient and a lot more efficient if I just download an app, check a number of boxes of things that I want and have it delivered to my house, or for me to pull up to the store and have them put the goods in my trunk. So we believe that e-commerce sales is likely to be a continuation over the coming several years, if not decades. And so for those companies that have already spent the monies to not just create apps and to create marketing dollars to get people to download the apps and use them, but also the distribution networks to be able to provide goods in real-time delivery, those are the companies that are going to thrive. The other companies that sort of looked at e-commerce as an expense, not something that is more critical or part of their strategy, they're going to continually languish. They're so far behind the curve that there's no amount of money, no strategy that they could deploy that would allow them to even try and attempt to catch up to those companies that are much more technology enabled. And so for us, the secular story of growth over value will persist over the coming decade. You just have to be mindful, though. It's done immensely well in 2020. So rotation, a little bit of a breather, can be had for 2021.
Okay, great. And there's a lot of talk about the concentration of the stocks that made the return of the S&P, especially over the last year with really just the top 5 stocks, the FANG stocks, everyone calls them. Do you see that continuing with this theme of e-commerce, or do you think it will broaden out a bit more?
We do. We do believe that longer term, if you look at, the FANG friends, right, you could add Microsoft to that as well. These companies are just so dominant in not just online retail. You look at a company like Amazon, they're dominant in online retail. They acquired Whole Foods, so they're a big leader in groceries. They also have a big cloud computing business, so they're a big software vendor. Now they're also an emerging threat in online retail. So this is really almost, you can consider it 3 or 4 companies in one versus just one company. And they're dominating in all the categories. And so for us, the continuation of the Amazon story is not likely to end anytime soon. As well, you can look at, not just Amazon, but you look at companies like Google or Facebook and all the dollars spent in, continuation of sort of online sales, and those companies that are able to capitalize through their advertising platforms. We don't believe a new Google or a new Facebook is likely to emerge in the coming decade. And so as a result, we believe the continuation of those companies that dominate, not just those existing businesses, but perhaps stretch into other areas of the markets could certainly be had. And so we continue to favor those stocks. Now, the narrowness of sort of the market recovery in 2020, again, is something worth highlighting. And so a broadening of that rally should occur in 2021. But if we're talking longer term, the decade ahead, would we bet against the FANGs? No, we would not. We would probably still have them in our portfolios. They'll still be sizable investments in our portfolios. I just wouldn't own just FANG though. I'd also consider, right, perhaps, selling some of those gains and perhaps diversifying to other parts of the markets that haven't done as well.
Okay, great. Thank you for that. And you working for a multi-asset strategy team, one of the asset classes we haven't discussed yet is which we can't ignore, is obviously the international sides. And interestingly enough, the international markets have been really underperforming the U.S. markets, quite frankly, for a decade now. This chart is showing a bit more recent. And some of that was due to the dollar and the strength of the dollar. And I'd be curious to hear your view going forward on investing in the U.S. versus international. How does the dollar play into that going forward?
Yeah, I would highlight that well-managed companies, opportunities for innovation and continued innovation and growth don't only exist in the United States. Yes, we absolutely know about the FANGs, but there's FANG equivalents that reside elsewhere. In areas like China, you have Alibaba and Tencent and Baidu, that are all sort of Facebook, Amazon type companies. Even in a country like Argentina, where some would obviously sort of question the viability of their economic growth, you have a company called Mercado Libre. That's Argentinian, but its businesses is spread throughout much of South America. It's almost like the Amazon of the Amazon. It's a big, online retailer and financial services platform and throughout South America. And so for us, we look at, companies. We don't just focus on the regions or how, U.S. has done relative to the rest of the world. But if we are looking at this chart, one of the ways you could help explain why the U.S. has done so well is that in that 10-year period after the 2009 financial crisis, you had a period where the U.S. was generating economic growth at a premium to Europe, at a premium to Japan. And so as a result, when investors were looking at where they wanted to invest, they were looking at, well, the U.S. seems to be firing on all cylinders, and Europe and Japan seems to be limping along post-financial crisis. Also, global investors who aren't necessarily focused just on equities, but sort of global trade and currencies, they're looking at, well, I could put my money to work in the U.S. bond market and get paid a considerable premium in yield versus what I could get in terms of negative yield in Europe. And so there was this persistent strengthening of the dollar over the last decade. Interestingly, that dollar strength has now become weakness in 2020. And the expectations is for continued weakness in the dollar for the foreseeable future. What this means is that U.S. equities may be a little bit more challenged relative to owning global equities. As the dollar decreases in value relative to global currencies, that actually improves the performance of global investments. Now, why do I have this view? Why does the T. Rowe Price's sort of research platform have this view of the U.S. dollar entering a weakening position for perhaps an extended stretch of time? Well, if you look at this pandemic and the recovery expectations post-COVID pandemic, U.S. economic growth is no longer at a premium to the rest of the world. If you look at economic expectations in terms of economic growth for the U.S. versus other G7 nations, as well as more broadly, the U.S. is more or less in line with a number of core markets. Also, if you look at U.S. investment grade, U.S. Government bonds, the 10-year Treasury yielding less than 1%, adjusted for inflation, generating an absolute sort of negative real return. The fact that you get, maybe less than 1%, but inflation expectations are going to be 1.5 or 2%. So you lock your money in the U.S. government bond, and you're guaranteeing yourself a negative after inflation adjusted impacts return. That is no different than what you get in Europe or throughout other parts of the core developed market. So the U.S. is sort of a growth and yield or income premium relative to the rest of the world. That theory has is sort of completely flip-flopped. And as a result, we believe that US dollar is likely to enter a period of weakness for a considerable period of time. So consider not just what the dollar is going to do or not do, but investment implications to your portfolio. This should provide a more favorable backdrop for global investments. Look to owning things outside the US in terms of international equities or international equity strategies.
And do you have a preference? I shouldn't say preference, but what's your view on the developed markets versus the emerging markets?
Yeah, so our area or the area that we tend to favor is the emerging markets. Emerging markets, I know for some seem risky. It's a lot of China, right? You've got other countries in there like Argentina and Turkey, and you start to wonder like, what am I really paying for? Well, for us, when we say emerging markets, we look at the emerging market as an area of opportunity. And why do we say it's an opportunity? Well, there's a very large middle class and growing middle class. You have sort of a younger population that's now getting jobs and sort of actual wage inflation. And so what these middle class individuals in the emerging markets do is they tend to follow the American sort of path, and they start to transact and spend their dollars and even borrow money to further increase their ability to spend. And so this is going to create a virtuous cycle where you're going to have a liftoff in economic activity throughout much of the emerging markets. Now, when we invest in the emerging markets specifically, we don't just say, let's go get all of it, right? We go and selectively add to companies that we believe will truly benefit from not just the secular theme of a growing middle class, but also companies that are well managed, that have executives that are focused on shareholder returns, that have companies with very little debt on the balance sheet. And so as a result, they're more quality-oriented companies that can organically grow. And so we tend to focus on the bottoms up versus the top down in terms of how we implement our monies into the emerging markets.
Okay, great. Another question I'll ask you is looking at the media today, there is a lot of scrutiny around the future of what they call a 60-40, which is in our terms, just a diversified portfolio, 60% in stocks, 40% in bonds. And that's been a staple of an investment process for decades of how investors should allocate. And I saw in October that Barron's quoted that the 60-40 is dead as an example. So can you explain a little bit about what the concern is from the media on this 60-40 concept and how you would address it?
Yeah, a 60-40 portfolio is sort of the industry standard for what they would say a individual with sort of a moderate risk level should allocate in their investment portfolio. 60% stocks, 40% bonds. And that profile has largely worked over the last several decades. It's provided, a 60-40 portfolio has provided mostly equity-like returns with a considerable less volatility. So the combination of I'm getting sort of the high octane return, but I'm also getting more of a smoother ride in terms of sort of less concerns about market sell-offs and what that means to my investment portfolio. Now, embedded in that 60-40 is that U.S. government bonds over the last several decades paid a considerably higher rate of interest than it does today. I'm sure some of you can recall back in the 80s, perhaps getting 10% or more on government bonds. And then in the 90s, it was, sort of 7 or 8%. In the 2000s, it became 5 or 6%. Well, today, certain government bonds are paying you effectively 0, 0.5%, or maybe at best about 1%. And so if you think about that, the income stream coming from that 60-40 portfolio is considerably less today than ever before. And with lower levels of guaranteed income coming from government bonds, that means the stability of the portfolio is a little bit less than before. Perhaps government bonds, which is always considered to be safe and secure, will be a little more volatile in nature going forward. Now, for us, this doesn't mean that the 60-40 portfolio is dead, but it does have important investment implications. It means, one, should you choose not to do anything, you need to expect more volatility going forward. That smoother ride is perhaps going to be a little bit more of a bumpier ride in the foreseeable future. So that's number one. Number two, if you do want to make some adjustments, you have to be willing to talk to your advisor team, right? work with the partners at Principal Wealth, and share with them what outcomes you're trying to generate. What are some of your concerns regarding the overall portfolio? Don't look at things in isolation. This is what my stock should do. This is what my bond should do. Look at in the totality of all of your investments. And if you're looking at it from a totality, you'll start to understand, in the past, these government bonds provide me insurance and income. Today, they're only providing me insurance. And that insurance may not necessarily be something that I need quite as much. And so as a result, I may be willing to allocate to other parts of the fixed income or bond market, or I may be willing to increase my equity allocation. I don't have a simple answer as to what that should look like for each individual on this call. But what I do believe strongly is if you were to do nothing, you should expect more volatility in your investment portfolios. And if you can't stand that, you need to reach out to your advisors at Principal Wealth and work with them to share your concerns, share what type of outcomes you're looking to generate, and be a little bit more open-minded in terms of the different investments that you have in your portfolio.
Well, thank you for saying that. We at Principal Wealth Partners agree with you, and that has been top of mind for us going into 2021. So we talked about a lot. Going around the world and back in 35 minutes is not easy. So thank you for that. I have just a few points that I jotted down if I can read my writing as you went along. First point is the economy is poised to do well in 2021, but the training wheels are coming off. I have number 2, don't make any hero bets in regards to stocks and bonds. Number 3, innovation is everywhere, so we need to think globally. And then my favorite number 4 is what's worked in the past, like a 60-40 portfolio, may not necessarily work the same going forward, but you can't abandon it. Is that fair to say?
That's exactly right. I think that's a great summation of some of the key investment thoughts that we're sharing within T. Rowe Price, and I hopefully was able to get across to this audience today.
No, as always, you're fantastic. We appreciate the time. You are welcome here anytime, and we hope for you have a great 2021 year as well.
Well, thank you very much for having me. I look forward to potentially meeting everyone this time in 2021 versus doing things remotely, doing things virtually. I really miss my trips up to your neck of the woods, and I certainly hope to be able to be able to meet everyone at some point in 2021. So thank you.